I'm using question 27 of the textbook to look at the application of the equity method. Now, the first step in the equity method is to do an acquisition analysis. This is similar to the acquisition analysis that is used in the preparation of consolidated financial statements at acquisition date, because we're going to compare the fair value of the net assets acquired against the cost of the investment, so what we've paid for the investment. We do this analysis to see whether there were any goodwill acquired or whether there's an excess that needs to be included as income. So I've written here in consolidation we talk about a gain on a bargain purchase, but in equity accounting we just talk about excess income. So just give you the background on this question. We've got Bell Limited, who has acquired a 30% interest in Chimes Limited. Chimes Limited is one of their suppliers. It cost them $13,650. That's what they've paid for the investment. And the directors of Bell Limited is of the opinion that they exercise significant influence over time. Now, you know that significant influence is the criteria that we use to decide whether a investment in a company should be equity accounted for. The criteria for consolidations, you know by now, is control. So we have to decide whether we've got control over an entity, in which case we'll consolidate it. If we don't have control, then whether we've got significant influence, so whether you can influence the business decisions that associate makes, whether you can influence their policies. There's all different indicators that we've got significant influence, in which case we'll apply the equity method. The question then further tells us that the equity of Chime Limited at acquisition date was $30,000. Now, you know that if you've got the equity figure of the associate at acquisition date, that is equal to the net asset value of the associate at that date, valued at the carrying amount, so the amounts that are included in the accounting records. When we made this acquisition of the equity stake in Chime, what did we actually acquire? We acquired our share of the identifiable assets and liabilities. So I'm just going to say net assets valued at fair value, as well as a possibility of goodwill. In order to be able to identify whether we have acquired any goodwill, we have to, first of all, adjust the assets that we've acquired at carrying amount to fair value. And the way that we do it is to make a fair value adjustment for all the assets and liabilities that we can identify and which has not been valued in the accounting records at fair value. And we bring that adjustment into our acquisition analysis calculation. The fair value adjustment is made after tax. In our further calculations, we're going to work with the profit figure after tax. So all our adjustments that we make, we do on an after-tax basis. Okay, so that brings us to our net assets and liabilities at fair value. We then calculate our share of those assets. That is 30% of the 40,500, which is 12,150. We paid for that our share or our investment in the associate, and we paid 13,650. So we can clearly see in this scenario that there's goodwill of 1,500 acquired. So we were willing to pay more for our share of the net assets valued at fair value, and to the amount of $1,500. Now, in equity accounting, this goodwill is not shown separately, as is the case with consolidations, but it's included in our cost of investment. So in Bell's accounts, we will have a line item, investment in Chime Limited, at 13,650, and that includes the goodwill that we've acquired. If we've paid less for the investment than our share of the net fair value acquired, so for example, if we paid $11,000 for this investment, we'll have excess income, and the accounting statement requires that any excess of our share of the net fair value of the identifiable assets and liabilities acquired over the cost of the investment must be included in calculating our share of the associate's profit or loss in the period in which this investment is made. So if there's excess income, this income will be recognized as part of our share of the profit of the associate in this specific year. So if I remember in the question, the acquisition was made on the 1st of July 2011. So in that 2011-2012 financial year end, the excess income will be included in our calculation of our share of the associate's profit and loss in that adjustment. In this example, the fair value adjustment related to a depreciable non-current asset where there was a $15,000 fair value adjustment required. These depreciable assets were expected to have a further 5-year life. But because we've included our cost of investment by taking into consideration the fair value of the assets and liabilities acquired, and the fact that this fair value adjustment here is a notional adjustment, so it's not made in the records of the associate, but only when we calculate our share of the net fair values acquired. It means that the depreciation charge relating to that in subsequent years basically relate to pre-acquisition equity that existed, and as a holder of the shares, but and equity accounting, we're not entitled to that pre-acquisition earnings or equity. So an adjustment will be made every year in our calculation of our share of the associate's profit and loss for this depreciation. So the extra depreciation relating to the fair value will reduce our share of the profit or loss of the associate. But remember, once again, because we work with an after-tax profit figure, our depreciation adjustment will also be an after-tax adjustment. Okay, there's going to be 2 more slides where, or video clips, sorry, where I look at the same example, but the journal entries then that are passed in 2 different scenarios when Bell Limited does not prepare consolidated financial statements, and then a next clip looking at when Bell Limited actually do prepare consolidated financial statements due to their group structure, and but even though they equity account for Chime Limited, the adjustments are not passed in Bell's accounts or in the group structure accounts, but only on the consolidation worksheet. If there's any further questions on the acquisition analysis and the treatment of the goodwill or the excess income, you're welcome to post a question on the MyGuru forum.
Made with Doodlecast Pro.